By eating out a little less, you can save tens of thousands of dollars towards your retirement. Individual retirement accounts, or IRAs, allow you to invest money in your future and in some cases even get a tax deduction. Retirement investing is not as difficult as it might sound, nor does it require a dramatic change in your current lifestyle. Many people visit workplace vending machines and coffee shops but believe they cannot save towards retirement. Some of these same people think that because they make a modest salary that they should not even bother contributing to an IRA or a workplace 401k plan. With compound interest and average return rates of at least 5%, you can turn a little into a lot by the time you are ready to retire. Let's take a theoretical 35-year-old who would like to quit her job as a secretary in 30 years. She barely makes ends meet and does not see any place in which she could cut her expenses. By giving up some of her coffee, fast food, and magazines, she slashes $50 a month from her budget and places it into a Roth IRA. When she retires, her fund will be at least $41,856. This is with an average return of 5%. That amount of money plus any Social Security benefits will help her get through retirement with some semblance of comfort. What if our secretary decided to eat out one less time per month and contributed $70 to a Roth IRA? Her retirement fund will grow to $58,599, and all of the earnings are tax-free. So what are some advantages of a Roth IRA? Well, you can withdraw your contributions tax-free at any time. You can leave the proceeds to your heirs. If you're under 50, you can contribute up to $5,000 each year, and if you're over 60, that annual amount increases to $6,000. What are some disadvantages of a Roth IRA? You cannot use the account as collateral for a personal or business loan. Your contributions are not tax deductible. So what is a traditional IRA? A traditional IRA is a type of IRA that is often eligible for a tax deduction today, meaning that you can delay paying taxes earning interest on money that was supposed to go to the IRS. But a traditional IRA has a few caveats. You pay taxes in the future on all gains. If you're a savvy investor and get a 10% rate of return, you can risk losing more money in the long run compared to if you were to invest in a Roth IRA. Also, you cannot leave the proceeds of a traditional IRA to your heirs. You must begin making withdrawals from it when you are 70 and a half years old, even if you do not need the money. And getting money out early is much harder than it is with Roth IRA. So what are some advantages of a traditional IRA? You can convert it into a Roth IRA if you wish to do so. If you will be in a lower tax bracket during your retirement years, then the taxes assessed will probably not significantly decrease your accrued assets. You can contribute up to $5,000 per year if you are under 50 and up to $6,000 per year if you are over 60. What are some disadvantages of a traditional IRA? All withdrawals, whether before or during retirement, are subject to state and federal income tax. Again, this is also going to be the contributions that you've made. If you do not start making the mandatory withdrawals by the age of 70 and a half, the Internal Revenue Service automatically confiscates half of your retirement account. It would be remiss to talk about IRAs without bringing up 401k plans. If your employer offers a 401k plan, take advantage of it. They work very similarly in concept to the traditional IRA with a few differences. Your employer automatically deducts your contribution from your pre-tax income. Many employers partially match contributions, which gives you free money to invest. While getting money out of a 401k early is not easy, most employers will let you do so if you can prove a financial hardship. Some companies will also let you borrow money against your 401k. So, don't literally throw your future away by not investing in at least one of these retirement plans. You can gain a lot by giving up a little. Contributing to a retirement plan becomes addictive, and even if you do not ever make a six-figure salary, you will probably want to contribute more by cutting out unnecessary expenses.